Okay. Welcome everyone to this special webinar on the war in Iran, what it is about. And it's about more than Iran, we believe, although we're not entirely sure of all the potential outcomes here, both for Iran, for the wider region, and where this sits within the US China conflict or rivalry or whatever it is you would like to call it. Um, I am John Hardy, John J. Hardy, Saxo head of global head of macro strategy. And on the left of the screen, you can see my esteemed colleague, Ole Henson. He is the head of commodity strategy and the expert on all things, certainly oil and gas, but otherwise commodities more broadly, with some great perspectives on what is going on the ground, where we need to focus, and what the market is saying and what the market is not pricing here, importantly, as we look at this unfolding crisis, where we are, where we could be as we go forward. So lots to talk about today, to say the least. I'll kick it off with a few thoughts, just a couple of points of order here. Do note that the on your upper right, there should be two, I think, two tabs available, if you will. One of them is there's a handouts section. So if you'd like to download the PDF of this presentation today, you can do so on that handout tab. There's also a questions tab, and you can pop in there and post any question you may have at any time throughout the presentation. We won't necessarily pick those up immediately. I'll be looking at some of them while Ula is speaking, but certainly at the end, we're hoping to leave at least 15 minutes, maybe more, for any questions or discussion points you'd like for us to follow up on. We may go over a little over an hour here, just for managing expectations here, but that's approximately the time limit we'll try to maintain. All right, let's see if I can dive us into the slides here. Look at a few things. First of all, yeah, and this, by the way, this picture here on this intro slide is of Karg Island. This is the island just off the coast of Iran, very close, way far up to at the end of the Arabian or Persian Gulf, depending on your point of view, where a lot of their oil offloadings are happening, something like 90%. Now, I think there are some ways to reroute crude. It's not the only spot, but where the bulk of Iranian exports happen, there are rumors, if this conflict continues, that a contingent of U.S. foot soldiers, Marines, and otherwise may be on the way. And the next, next step could be in the confrontation to actually seize this island. Certainly an important oil supply point for Iran and really for the world, because the price is often set in the last million barrels or two of crude. And then we have the new supreme leader, who nobody has seen in quite some time, Mojtaba Khamenei. Let's see if he shows up at some point. Important to, as a initial point here as well, to point out that anything we say today should just be seen as mine and Ola's thoughts on markets, where they are, where they may be headed in the future, should not be taken as investment advice or a recommendation. So please do keep that in mind, and especially some of the theories around what this is all about are not founded on major media or anything like that, but upon many other analysts and our own thinking. And there could be 10% truth within it, within a larger truth, 50% accuracy of what the general gist of all of this is. I just think there's some important perspectives to include in this conflict and what it may be all about, and to see if the incoming news corroborates that or not. So please do keep that in mind as well. And that's what I'll kick off with. That, what is this war in Iran all about? Well, there's the theory of, or the tool of Occam's razor, which is, look, let's just take the simple facts on the surface and not try to get involved in too much complexity here. Israel felt that Iran was an existential issue and its nuclear program needed to be taken out before it could develop nuclear weapons, and potentially as well before its missile and drone program became so overwhelmingly strong that it could risk destroying Israel, whether through conventional or nuclear aims or nuclear methods. And the U.S. felt like, well, if Israel is going to launch this attack anyway, the thinking goes, it felt like it needed to be involved. It also helps to maybe take out a global, one of the allies of the global rival, at least China, as well as Russia. and to aid its own allies in the Middle Eastern region who find Iran's proxies, whether it's Hezbollah, the Houthis in Yemen, and otherwise, as irritants for, and even Hamas and Palestine, irritants to stability in the region. So that's the sort of the Occam's razor view of what this is all about. Uh, and then you can go, and the reason the image on the right is actually from the film A Beautiful Mind, about John Nash, the mathematician who was developing all these complex, crazy conspiracy theories about what the world was conspiring to do, maybe for and against his own person. And there are many theories out there, but I think one of the ones that has a broad truth to it is that this war in Iran is not just about those things. It is also about those things, but it's also about access, China's access to cheap oil, and the U.S. wanting to disrupt that. I'll get into that later, but I do think that this has a very distinct U.S. versus China angle to that, and that's going to be the bigger playbook that we need to watch for beyond these headlines on the near term on whether we're seeing peace on the ground. And if we go to the latest headlines, it just seems every day we get a new one that changes the vibe, changes the hope on where this is headed. Now, right now, we have markets pretty almost euphoric, I would say, especially in Asia overnight. Europe to a degree this morning as well. U.S. futures are also up because late yesterday, U.S. President Donald Trump forwarded this, 15-point peace plan. The number of points isn't so important. The gist of it being the stuff you would normally expect. Iran needs to totally unwind its nuclear program. It cannot have any nuclear material. It needs to hand that over to the International Atomic Agency. It can never move to develop nuclear and enriched nuclear materials in the future. It can only use its missile program for defense and a number of other measures. Iran's apparently spinning out or responding with its own measures, like we can do whatever the heck we want with missiles. The U.S. needs to remove all of its bases from the region, and we're going to basically charge for ships to go through the Hormuz Strait, among other points. Both sides not on the same page, and we do not have a peace deal, but we have negotiations, and we have the overall impression, which is I think is the market's most important takeaway, the overall impression that we have a U.S. president that really wants out of this conflict because he doesn't like what it does for his approval rating via the pressure at the pump on gas prices in the U.S., petrol prices in the U.S., and he doesn't like what it does to the stock market. He doesn't want to, quote unquote, wear any stock market declines ahead of the U.S. midterms. It's kind of ironic then that you're seeing that middle story there, also from the Wall Street Journal, that maybe some of the regional allies of the U.S. effort here, Saudi Arabia, UAE, among them, that they want to see this thing through potentially. They don't want to see this Iranian regime persist, and then maybe starting to develop some of these weapons programs again, only to potentially launch them down the road at some point. So, and again, what are the sources here? How much should we trust some of these sources? We don't know, but that could be one angle to this. That even within the region, the U.S. has launched this attack, but it can't necessarily decide how things wind down once the hostilities have been fully engaged. And then if you look over at other points on the press or other press sources, you get a very different feel of things. I took a clip from today's Al Jazeera, in fact, just a couple of hours before starting this webinar. You see the breaking headline there. Iran's military dismisses Trump's claim of talks and vows to continue fighting. On the lower right there, you see him quote that U.S. is talking to itself. And some speculation on the top right there is Iran's negotiating position stronger than the U.S. is when the U.S.-Israeli war started. Now, this is not to endorse these views. It's just to say, do we really know it very much at this point? And I think that's the difficulty here. This is the fog of war. By setting this war in motion, I'm not 100% sure that the U.S. president can control the narrative. So I would just be a bit reserved in jumping on every single market reaction to headlines. And I think as Ola will now take you through on the supply side, we have some huge concerns that are already baked into the cake as we look at as we look at the implications for supply chains from what has already unfolded, much less if this persists merely a week, 2 weeks, 3 weeks, or more longer from here. So, Ola, I'll let you take it away on the next few slides, starting with just a little perspective on the Strait of Hormuz itself and why it is so very important.
Yeah, thank you very much, John, and welcome back, those of you who joined us a week ago. Whether we are wiser now than we were a week ago, that obviously remains to be seen. But as John said, the market is trying to price in some kind of a deal to move closer to a solution, and we're seeing prices of crude dropping, and some of the recent decliners, something like gold, has risen quite sharply today. So there is some hope in the market, but let's just turn our attention to the reason why is some may argue that it doesn't really matter what Trump says at this point in time, because Iran holds the cards because they control the Strait of Hormuz, and that's really where the whole problem lies. That through this narrow strait, so much of the global supply of energy, fertilizers, helium, naphtha, LPG, what have you, goes through, and it is over time and starting to, and increasingly so in the coming weeks, if we don't see a solution, will continue to tighten the global market. A lot of this, you also, I think it's important to look at this from east of Suez and west of Suez, so the Suez Canal, basically because the supplies from the Middle East historically or in recent history has gone primarily to Asia, and that basically means that is where the immediate tightness is being felt. And what is also important to note is that in the days where the war broke out, the price of crude rallied for worries about a supply disruption. Now, as we get 3 weeks or almost 4 weeks into this conflict, this supply disruption is starting to emerge. And I'll just show that on a slide a little bit later. But John, if we take to the next. That's basically just to give an idea about the developments we've seen across markets this month, especially in the commodity space. And as you can see, crude oil and WTI, yes, they have rallied, but where we have really seen the big moves, and I have not even put in those that have surged by the most, but we are seeing an impact on gas, on diesel, and on both in stateside and in Europe, simply because a lot of refinery capacity is stuck inside the Persian Gulf. That basically means diesel or the middle distillates, that is the feedstock for diesel and jet fuel and other fuels, are primarily produced in the Middle East, and right now we're not getting that to the market. So that's why the tightness is initially being felt in that kind of middle distillate bracket, and that's jet fuel, it's diesel, it's fuel oil for ships, but it's also some further down the barrel, some of the thicker products that are starting to be in short supply. Ships send. Let me just take that in a second, because we also just, if you look across to the on the right hand side, just highlighting some of the ETFs across the key markets that we follow. There's obviously a lot of equity markets there, but also some commodity related ones at the bottom. And as you can see, we've seen quite a significant increase in the energy, which makes sense. Energy companies are reaping the rewards, those that can still sell and produce. But at the same time, we've seen quite a significant setback in the precious metals and industrial metal space, and that's on a combination of the fact that we have seen this liquidity driven sell-off in precious metals, which has been strengthened by the risk of higher energy prices causing inflation to reemerge, changing the central bank outlook for rates, and also driving up yields and the dollar. At the same time, mining companies are also facing higher costs through the diesel, which is, as we've shown on the left-hand side, has rallied quite substantially. So higher input cost and lower prices for what they sell has triggered this major correction. But as you look on on a 1 year basis, it's still one of the most one of the most profitable sectors, and we are now starting to see that area stabilizes as well. Next slide, please, John. That just highlights the importance of the Persian Gulf, how much of the global supply that's delivered through this narrow strait, and you can see, well, in percentage term, fertilizer is a massive one, and we're just going to just focus on that in a little bit later, and the potential impact that could have on food prices and availability if this carries on too long. We're already starting to see some impact of it. Australia has farmers will plant less wheat simply because it's quite nitrogen intensive, and they will be looking at other products to plant, but there is a risk to the overall level of production. Helium is another one, which I think has surprised many in terms of its use, and you can chip in on that, John, if you want. Mike.
Typical me to forget the mute button. I just wanted to break in briefly, Ola. Sorry to interrupt, because I'm already seeing two questions about whether this will be available for viewing later. And the answer is yes. The recording will be made, is being made right now, and you can find it if you just Google Saxo webinars and go to the Saxo webinars page. Down at the bottom, within some minutes after we complete this webinar, we upload the full recording. So you're certainly able to view this offline, or if your connection is bad or whatever the reason, or if you want to pass along the link to a friend, etc., will be available as a recording. I should have mentioned that at the outset. So just wanted to butt in and to mention that. So continue.
Yeah, perfect. Please. Perfect. Yeah. So the helium is one part where it's used for production of high quality microchips, and that's why suddenly it almost may have an impact on that part of the economies. I just saw on the question as well, let's just round up the gold and silver story, because I know it has been an incredibly popular investment for the last couple of years, and I think the correction has probably taken many by surprise. I think we only have to go back to the 2008 global financial crisis to see what happens when we have these kind of crises, because the main first reaction from investors is basically to go defensive and go liquid, and you can almost argue that gold has suffered from its success in the last many months, simply that it's become such a widespread investment held by many, and as you need to reduce, or in some cases gain liquidity to offset other losses perhaps elsewhere, that has really been hurting gold at a time where as well suddenly the whole narrative, the macroeconomic narrative, has suffered a sharp reversal, and that as I mentioned, we've seen inflation expectation pick up. We've seen rate cut expectations in the U.S. this year been removed completely. We briefly almost looked at rate hikes earlier in the week, and at the same time, bond yields has moved higher. 2-year notes in the U.S. briefly traded above Fed funds, indicating as well that we potentially were staring at a rate hike. I don't believe that will be the case, the outcome, no matter what, almost, because right now this is a supply-driven shock. It's not a demand one. That basically means the economy perhaps at some point may even need some stimulus if this continues to escalate. But gold will reassert itself. I'm sure nothing is certain in this world, but once the dust settles and we normalizes, then the traders will start to look at suddenly gold at a much lower price than we were, and also that the long-term reasons why gold were bought in the first place has not really gone away. So I'll leave it there. I'm happy to take more questions if there's anything on it a bit later. Let's move to the next, John. Because I talked about the crude oil prices, and what has been really, I think, to a certain extent, a bit confusing is that investors and traders been looking at Brent and WTI and say, what is the problem? We know we're not even near the spike we saw during the Russian invasion of Ukraine in 22. So where's the problem? Well, the problem is really that, as I said, we have a east of Suez and a west of Suez situation where the price of Brent and WTI is primarily due to related to production around the Atlantic basin, but whereas the tightness we've seen initially is coming from the Middle East and beyond into Asia, and that's why we can see that something like the OPEC basket, which includes production from not only from Middle East but from the other OPEC members, that is trading at a substantial premium to where we find Brent and WTI. So Brent and WTI is not telling the story right now. It is the other crude contracts and the underlying products. What has helped the market in terms of crude availability is the fact that we went into this war with a substantial amount of crude stock at sea, either in the shape of sanctioned oil from Russia or Iran, or just simply because there was an overhang of supply that was looking for a buyer, and that meant that in the first few weeks that there was crude around. It just had to be redirected to where it was needed. I'm showing that on the left hand or right hand side here. This is basically a measurement for global oil stock at sea. And as we can see, there's been a dramatic reduction in the past few weeks, so much that we are almost back to the 5-year average. And that there will always be oil at sea because ships are on the move. So we are getting close to levels where that story is no longer going to be supportive. Also remember, it takes time from a ship to be or tanker to be loaded till it reaches destination. And with a lot of these ships that or tankers that left the Gulf before the war started, say 3 weeks ago, they have now only in the last few days reached that final destination, offloading their cargoes of crude and fuel. And that basically means it's from now on, basically, or within the next week, if we don't see any change, that we will start to see the tightness start to emerge. Because one thing is speculating about the tightness, one thing is when it becomes real. It is real already in the fuel market, but the crude oil market will be more a story as we move within the next few weeks, I would say. Next slide, John. I'm just gonna just take the next one, John, just so we just finish off the. I mixed them up a bit. Just to show again where we have seen some of the big price increases. We've seen that in jet fuel oil that goes onto ship, gas oil, the futures in London, which is primarily diesel, Middle East fertilizers, the urea, and the European gas contracts. All of these have seen substantial increase and now obviously trying to come back to lower levels, and much of that really depends on what happens next in the Middle East. And just back to the one we had, John. Yeah, because as I've talked about fertilizers, and it's really important to understand the massive impact this potentially could have on production this year and almost next as well, but at least in the coming months. And we're just about to enter the planting season across the northern hemisphere, and farmers need diesel to run their machines, and they need fertilizers to make sure that they reach the level of production that they are targeting. And right now, both have gone up in price, and whether fertilizer is in short supply, I have not heard reports about that, but the price being paid has gone up substantially. That basically leaves the risk that we can either see lower production through less use of fertilizers, or we can see farmer make last-minute changes to their crop mix, moving towards some crops that may have a lower or have a lower dependency on nitrogen-based fertilizers. And I put some of the crops on the left-hand side there, which you can see which are the ones that are most dependent. Unfortunately, we have some like wheat and corn right at the top, but also other really the most important staples for food consumption in the world, rice as well being one of them, are all in this category. So it's one that could have a significant impact again if we don't get these supplies flowing fairly soon. Historically, there has always been or at least in recent history, quite a decent correlation between energy prices and the cost of food, and it comes through the fertilizer link, but clearly also comes through the cost of production. If the cost of energy goes up, say diesel, then the cost of producing the farm goods goes up as well, and that will have to be reflected somewhere, and that is often reflected in higher prices. I think that's it on that one, John. So let's just finish off with this one in my segment on the importance of what we're seeing right now. Goldman Sachs has calculated that up to 80% of the basket, the Bloomberg Commodity Index basket, which is basically 26 major commodity futures, is the one that I normally report and tracks because I like the broad exposure across energy, metals, and agriculture. But Goldman has estimated that 80% of this basket is directly or indirectly exposed to the war, primarily through supply losses. But you can also argue that the precious metal space has been instead of positively, been negatively impacted, at least for now. But it just highlights how significant this is if it continues to become or if it becomes a longer lasting story. But I think it also tells us a story that if you just remove my picture, John, so we can see the full graph here on the right, that if you look at the year-on-year changes in across these different indices, we actually find that the Bloomberg total return index is up more than 30% in the last year, and that's the total return is basically the return you can track if you buy an ETF that tracks this particular index. It's up more than 30% in the last year. But you can also see the massive change in precious metals versus energy. But you can see one has basically more or less offset the other. But so what does that tell us? Well, if we are in a world where commodities increasingly is going to be weaponized, where we see the breakdown in the supply chains that we've grown accustomed to, that things were produced and manufactured where it was cheapest, to where it's become much more important that it's closer to your home base or your home industries, then that competition for commodities potentially could signal that the trend points towards higher prices still in the years to come. And with that in mind, if you have a broad exposure to markets, then having commodities as I would say almost a hedge against some of these political uncertainties potentially could make sense. So I think that's basically the main signal from this, that the broad exposure really helps remove the peaks and troughs, but also means that you have the broad exposure at any given time, and because we never know what's going to happen next. Tomorrow's winners could be yesterday's losers, and vice versa. John? Mike? For some reason we lost you, John. Nope. We have lost connection. Okay. While you work that out, I will say I'll just take a look through some of the questions very quickly. One asked about uranium, whether that is how that's going to be treated. Well, I think once we get through this, I think the importance of diversification of your energy mix is probably even more relevant. Uranium has, just like many other of the mining stocks, suffered from its own success in in the last year or so, and that's why we've seen this setback. But I think once the dust settled, the focus on expanding or widening the energy mix to avoid some of this dependency that we're seeing here is one that potentially could add some fresh support to that market as well. I would just have a look through.
Testing.
You are back, John. You're back.
That's a different sound source. Does that sound okay?
It's okay. You're back.
Okay. I'm on my fancy podcast mic, and suddenly that wasn't working. Apologize for the technical difficulty there.
And John, I was just about to ask a question about the midterm election, the impact of that, but I can leave that to you. So I'll hand the mic back to you.
Absolutely. And apologies once again. Let's see if we can talk our way through this. Hopefully the sound is reasonable, good quality. I will just drop out the video here and talk a little bit about, I don't want to really delve into this. It's just one of those things to keep an eye on. I think one of the, again, so what is the Iran war all about? Well, let's remember what happened just before the Iran war, and that was an attack and a decapitation of the Venezuelan regime across the Caribbean from the U.S., a country that was, very much aligned with, basically a mafia-run state almost, some links with drug cartels, clear links with China and Russia in terms of its geopolitical alignment and lining up against the U.S., and a really dysfunctional regime in terms of keeping its crude oil output at levels that would have helped to enrich the population because it was managed so poorly. So the U.S. deciding, you know what, we don't want this bad actor on our near our shores. We're going to renew the Monroe Doctrine. We're going to call it the Donroe Doctrine, and we're going to make sure we don't care about regime change. It's not about ideology. It's not about idealism. It's about just realism. Let's just decapitate this regime and force them to realign to our desires and get the crude oil headed our way or where we want it to head, and not at subsidized, discounted prices to our rivals who are starting to fund weird things like potentially like unmanned underwater vehicles, etc. So we want our waters to be safe near our shores. So they take out Venezuela, and then the next logical step is Iran. And let's think about the Hormuz Strait. So here's a situation where the U.S. is now largely has a energy fortress and does not need itself really need any oil from the Hormuz Strait. It's the rest of the world that needs it. It's Japan at 75% dependency. It's China at 50% dependency. India at 60% dependency. We spent trillions of dollars on a war to topple the dictator in Iraq. And we helped them create our companies at least helped them to re-establish their oil production. And where's that oil production going to now? Through these nice, safe straits, or that are sort of being kept safe. It's going to China, and Iran is also using the strait for oil to China. So, why is this? This is just sort of the next logical step. Here's a pariah regime that's supplying China with discounted crude. I'm saying all this with this Kurdistan map on the slide here. I don't really want to bring Kurdistan that much into the discussion. It's just something to keep an eye on. The largest ethnic group in the world that does not have its own homeland or country, and is spread across 3 and really 4 countries if we include Syria. Let's hope this stays quiet. The Kurdish people are not terribly happy with the status quo, but this has many angles across many countries. But I wonder to also the degree to which Iraq, much of which its regime is allied, at least in some sense, with Iran because of the secular, the Shia religion reasons, and because there are also some militias that are sympathetic to Iran, etc. That's just one angle that can become embroiled in this, and it actually is embroiled to some degree with attacks on U.S. bases and assets in Iraq, etc. So just want to bring that in, and also what is Saudi's position here on all this question of Shia as well. But let's go back to actually some scenarios we put together on the immediate outbreak of this conflict and how we thought this might turn out. And I think it feels like this was a reasonable assessment of the possible outcomes. There was the so-called optimistic scenario in which we see this Iranian regime change. Now, this, of course, could still happen. And when we say Iranian regime change, not that there's a new sort of piece of the regime that takes over and kind of realigns a little bit cynically with the U.S., Israel, or otherwise, but like a proper regime change, either towards something more in the democratic direction, or with perhaps the Shah's son as a sort of stand-in, semi, what do you call it, a democratic state with a monarchy, etc. Low probability, but a probability. And then the sort of the main chunk was that we do see. That we do see continued uncertainty with a much lower level of conflict. And the idea here could be some kind of regime that continues along, but is just sort of, to keep the actual kinetic war at bay and to stop it, stops engaging in the conflict enough for these normal traffic to resume at some point within the time frame we are currently in now. That really appears what the market is gunning for. It's certainly where I think the energy markets are priced for significant traffic to resume. Some traffic is resuming through the Strait of Hormuz. The last I saw was something like 9 vessels going through. But this needs to ramp up pretty quickly. Otherwise, we get into, and this is a gray zone. These aren't absolute different scenarios. We start to lean into the worst outcomes of this middle scenario into this really disaster scenario, which would be that somehow Iran is able to continue with its attacks beyond, let's say, another 2.5 weeks or so, because we will see profound supply disruptions across supply chains globally if that is the case, and certainly not something the market is priced for. And then there's this whole geostrategic playbook that I alluded to. That the whole prior the globalist or globalism setup was that the U.S. sort of was the global hegemon. It could provide sort of security globally for trade routes, and it's provided the world with U.S. dollars and security for shipping and for trade flows to continue. And then it woke up one day and realized that China had secured access to critical supply chains up and down all of industrial products, but also these key rare earth materials. And that actually that at any time of its choosing, that China could essentially turn off the U.S. economy, especially militarily with its access to rare earths. So the U.S. is sitting here strategically very vulnerable and needs to come up with its own answer, its own way to provide leverage against this implicit threat from China. The only way it could do so, it felt like, this is one narrative, is to go after China's reliance on imported fuel, and especially oil and gas. And that this is a chapter in that ensuring that it has this kind of leverage, going straight for the jugular in terms of China's access to cheap energy, and ensuring that the U.S. has some sway over that. Now, why would the U.S. want to do this? Well, for the reasons I just mentioned, A, but B, to ensure that China does not have the leverage. It has the counter leverage to prevent China from turning off this the rare earth supplies, but as well to encourage investment into the U.S. If the U.S. is the place that is the most stable, the most welcoming of foreign capital, with the cheapest energy supplies, it really boosts the U.S. reindustrialization effort. It boosts the building of data centers and all kinds of other manufacturing, chips and otherwise, to ensure that A, that these supply chains are reestablished within the U.S., and B, that it has the cheapest energy to run AI data centers. And thereby, of course, you have an energy world that is no longer flat. Maybe you're if you're the U.S., you have your Middle Eastern allies, Saudi and otherwise, that are able to export at much, much higher prices because they have even more profound control over oil going through the Hormuz Strait than they did before. So Brent can maybe cost, I'm just putting out some random figures here, Brent can maybe cost $100, but WTI stateside costs $70, just as an example. Already we've had a natural gas market that is extremely favorable for the U.S. For U.S. industry relative to the cost of gas in the rest of the world. Now, China's answer has been cheap coal, but that has its own climate costs. So this buys the U.S. time, and another idea somewhat related to this is ensuring that the U.S. dollar remains the world's global reserve currency. There are a lot of people that believe that the Trump administration's embrace of the cryptocurrency infrastructure, and particularly the backing of stable coins, has a lot to do with continuing to ensure that the U.S. dollar remains the chief global reserve currency, and that even via stable coins, that the U.S. can essentially dollarize much of the world. Now, what could go wrong with this approach? Well, you have Trump's bullying style, and you have a loss of the traditional U.S. soft power. Now, the U.S. power was always very hard militarily since World War II, when it designed a lot of this global system under the Cold War, and then afterwards. Now it's sort of like they've just abandoned all the niceties and idealism and words about democracy, and it's just about bullying and hard power and leverage. And it just doesn't feel nice for a lot of the rest of the world that has been traditional U.S. allies. I think many in Europe would agree with that. So does the rest of the world want to play ball with this bullying approach? Or could, as the second bullet states, could Europe and India carve separate and different paths? You even have Canada's Prime Minister Carney talking about the middle powers banding together and creating their own sort of third way as well. What if this attempt at the Dunroe Doctrine? Yes, we have a sort of a mafia state in Venezuela that is playing ball with the Trump regime right now. But what if more democratic governments decide they don't like the way this is going and reject this? Or do they have the choice? And if they don't, what is the long-term picture of being sort of bullied into a position in terms of your foreign policy? And then there's the simple idea: is the U.S. moving with too little, too late? Does China make a move in terms of Taiwan or otherwise, or against this U.S. effort to secure supply chains, etc.? And then there's that, I use this word civil war, and what I mean mostly by that is just in a political sense. I think we can kind of agree that there is a low energy semi-civil war brewing in terms of the incredible incredible divide between GOP or MAGA, if you will, and the opposition in the U.S. Is there any outlook for that to improve? If you look at the opposite side, what is China and its allies? Some call this the dragon bear, and we may include Iran in this. What is their strategy to counter this? Well, basically, China has enjoyed the U.S. system and really took advantage of it with what some call predatory mercantilism, in which it used the system to secure access to supply chains. It didn't care about profits. The U.S. side only cared about profits, and when China starts to subsidize production in an industry just to gain control of supply chains rather than for profits, then naturally the U.S. loses that access to those supply chains, and they become based out of China. That's been the case for rare earths and all kinds of other industries as well. So it wants to replace the U.S. hegemonic system with its own. That one will be centered on China. It needs to undermine the U.S.-led alliance system. It needs to keep democracy and these color revolutions at bay. I think a lot of Russia's move against Ukraine was based on the same thing, the concern that democracy was increasingly at its doorstep, not only in Ukraine's Maidan revolution, but also the attempted revolution in Belarus. It needs to weaken Western financial institutions and the dollar system itself, replace that system with a China-based currency system. I think the massive rally in gold was in large part about China wanting to recycle its surpluses into something that's not U.S. dollars, but as well potentially to build gold reserves so that it has an asset it can use to base its own new currency system on. And then, replacing or even taking over existing multilateral institutions. We've seen them active in the World Health Organization and other organizations, and using that route as well. Of course, it's already dominating many industrial supply chains, wants to dominate more, and especially going up the value chain to higher value and higher tech value chains, from EVs and now even into robotics and physical AI, as well as AI itself. Basically, you end up with an economic system or empire centered on China, not a political one, not about the old-fashioned empires of troops taking over, but that you're at the center node of a trading system, that China sits at the top of that and is supplying the highest quality and highest tech, etc., to the rest of the world. What could go wrong with China's attempts to establish this new hegemonic system? Similar to the U.S., I mean, there's the soft power angle. Does China have a universalism that the old multilateral frameworks had, with idealism based on freedom and democracy and things like that, even if you question the honesty of that in the old days? Or is it too sort of nationalistic and too sort of specifically Chinese? Does it lack this universalism from outward appearances? That's actually the second point I made there first on what could go wrong. The other thing that could go wrong is that China simply overproduces in many areas, and when they're sending these subsidized goods all over the world, it just like with the U.S. and manufacturing in the U.S. that was killed off by decades under the globalist system. The Chinese trade rivals don't like their own supply chains and industries being eroded by Chinese overproduction. So China really needs to change its behavior anyway, just to become more of a consumer than just a producer. But I think that is the broad structure of where this is headed. And as I'll get to in the conclusion, I'll talk about how this could go very well if we're lucky. Just very, very briefly, just to China's oil import picture. It is profound how much China needs to import of its crude oil, more than half of it, a lot of it coming through the Hormuz Strait. And this is certainly, I think, a war that is aimed at straight at that setup. As well, what could the next step be after? Let's say we do get peace on the ground of whatever nature, even if it's a simmering sort of uncertain peace in Iran. I wouldn't be surprised to see a lot of focus on Russia and the U.S. trying. And why has the U.S. been so friendly towards Trump, or at least, why has Trump been so friendly to Russia? Many would ask. There are all kinds of conspiracy theories. Who knows? Maybe they're partially true. It doesn't really matter. Just from a practical point of view, this is the really big cheap energy plug into China. So it's the natural next focus, if there is a focus, to ensure that for example, a natural traditional U.S. ally like Europe normalizes relationships with Russia, stops caring about idealism and territory of Ukraine, which has no economic value, and just says, hey, just leave them alone and start buying their energy again, because it's just the practical thing to do, and you need cheaper energy. Can that succeed? I have no idea, but I think it's an important potential next focus if this winds down. Yeah, I think I'm going on too long. I want to be able to address a couple of questions, but there are many that have tried to sort of put some nice intellectual frameworks around the geo-economic landscape. Are we moving towards this sort of spheres of influence set up, China versus the U.S., or are we just splitting into sort of multiple nodes across the world with their own interests? And so some have come up with these sort of frameworks for trying to describe what's going on. You can see the link here. You can just look up this Stephen Desmuter on LinkedIn. You can see the link there, talking about deglobalization. That's sort of the unwind of the old system. De-Americanization, cutting off your relations with America because they're becoming a new sort of hostile force that you don't want to deal with anymore, with high tariff barriers, etc. Fragmentation, that we're just all sort of splitting into our own spheres of influence and need to take care of our own supply chains no matter where we are. And then re-Americanization, and he's even tried to chart this. And the most salient rise has been in sort of de-globalization and the move away from Americanization. So it's an interesting process we're all undergoing. Also keep an eye on rare earths. The U.S. military is very reliant on these. They're very much centered on China. There's been Chinese newspapers talking about the U.S. military has only 2 months left I'm sure that depends on which rare earth you're talking about, which application, etc. But it's a critical issue, and the U.S. is absolutely scrambling on this front. So conclusions. Yeah, war in Iran, maybe the pressures do completely fade here in the near term. The lessons will remain. Countries don't want to be vulnerable supply chain wise, and energy supply chain wise most critically. Europe really needs to get its act together on energy resilience. You have no AI credibility with these high electricity prices here in Europe. The next phase of the energy conflict is very interesting. China is very, very quiet. They're always very careful and slow to respond because they want to do it the right way. They almost never flash the sort of aggression card. So we need to keep an eye on that. And then there's the idea, I think this fourth point is really key here. So this is where the outcomes are really important. There was a Xi-Trump summit scheduled to take place early next week that has been canceled. Trump has tried to move it back about 1 month. I think the signals from a U.S.-China summit, if it should happen, are absolutely critical for the outlook in the medium to long term. Do we have the two giants here deciding, wait, okay, we see that the U.S. is taking this really, really seriously. They've got leverage now. China has leverage. Do the two sides agree that, you know what, we don't want, just like during the Cold War days with the nuclear threat, we don't want to get into a war. It's too damaging for us to get into a war. Either one of us can destroy the other if we continue down the route of leveraging to the ultimate degree the power over these key supply chains. Therefore, the best is to come together, make a really grand deal where we decide it's really important to secure access to global resources and move forward on some kind of schedule. Yes, China, you can have Taiwan someday, but just do it on a slow time scale. In the meantime, nobody's blocking anybody's access to resources. It allows the U.S. to slowly build up its industrial base and its access to rare earth materials, elements, and otherwise. And it's a grand deal, a grand bargain. That's has to be the dream. Is that where we go? I have no idea, but that's a key thing to put on the calendar if that summit is rescheduled. And then just very briefly on the other points, the physical world is underpriced. I think this conflict makes it clear. China has subsidized some very, very exotic and very, very expensive things to produce, made them so cheap that nobody else wants to do them. So there's a lot of investment potential in the physical world, rare earth minerals and otherwise. The electricity needed to power data centers and everything else under the sun that needs to be produced, not in China, but potentially elsewhere. This means massive industrial policy in the U.S. This is ongoing, but it could spread even further to this sort of war footing style need to secure supply chains could spread more, also to Europe, India, and elsewhere. The dollar on the decline. If you want to keep the dollar as the global currency, it needs to be liquid and it needs to be not too expensive. A strong dollar equals chaos and stress for global markets. A weak dollar is needed and is I think a natural long-term element of the outlook. Of course, in the short term, it can go much higher if this crisis gets a lot worse suddenly, because people are always scrambling for dollars when global markets are under major stress. There's a little bit on AI there at the bottom. There's a lot of interesting areas within AI for investment as well. But I don't want to extend the conversation too much. And then we'll look at your questions, but I just wanted to take the opportunity here to show you this, which is our referral. So if you're a Saxo client, and if you appreciate this webinar and what you're seeing on the Saxo platform, if you follow that QR code, you can refer a friend. We make it worth your while to do so with our referral program, and it should be country specific, that link, if you do follow it. So have a look there. And Ola, maybe I'll just hand it over to you briefly and let you address a question or two that I'm sure you've had a chance to look through there in the questions.
Yeah, well, there's been a few coming in. One was basically asking, well, if this is an energy crisis, wasn't it going to happen anyway? Well, the problem with the energy supply at this time in our history is that basically we are in an incredibly energy hungry world, where even though there's a lot of initiative to offset the fossil fuel part of the energy equation, the growth in energy demand just continues to outnumber those. So right now it's the real issue is really that we are in an energy hungry world. We've got the whole electrification, which is ongoing. It's not only electrical vehicles, it's data centers, it's cooling and so forth. And that basically means that a key feedstock in the coming years, probably in order to achieve this without considering the pollution aspect, is obviously natural gas, and that's why the natural gas price that we're seeing now is potentially one that will attract a lot of additional attention, because it just highlights once again the dependency both in Europe and Asia from imported gas, and how quickly the whole supply structure can be impacted. So that's really one we're going to watch very closely.
Yeah, I'm really curious with this damage. So we have this damage assessment on the Qatar's huge production chain of LNG, something like 17%. Originally, when they shut this facility down, and it is not running again. So we've had 3.5 full weeks of this production facility shut down. Even back then, they said it takes weeks to months to get started. Supposedly, they can turn back the thing on to 83% capacity, but how quickly has this reduction in capacity mean that startup period is that much longer? I mean, are we talking about a potential? I don't expect you to answer the question, but are we talking about a potential total disruption of 20% of global LNG supplies for maybe 4 months, maybe 5 months, and then we're getting into the winter build season, et cetera? So I think the ramifications already on the ground right now for something like gas, as you mentioned, are potentially quite profound. A key point, I think.
Yeah, and also just simply the fact that this is the time of year where spring arrives in the northern hemisphere. We start to rebuild our inventory levels. The problem right now, if you're buying gas to put into storage, if you can't get it, you are paying a higher price than what you can sell it for in the winter. That's obviously not a good trade, and that's the arbitrage window closed for that kind of normal trade where you buy cheap in the summer to sell expensive in the winter. So that is a challenge. But we did actually start 2026 and with an outlook for increased supply of gas. U.S. is increasing its export infrastructure, and with that in mind, the market was actually moving towards a well-supplied market, and it was also reflected in the prices we saw here in Europe and in Asia. They were coming close to levels that we saw prior to the Russian disruption in 22, and But now, obviously, some of those plans has been or projection has been put further out into the future. But the near-term stress is probably the one that is going to be the biggest, simply because we need to reroute and reconsider how we manage our gas supplies with such a significant amount of gas suddenly being taken offline for an extended period of time.
I can't emphasize enough, and you've listened to me, Ole, on previous calls over the last couple of weeks, how little the market has reacted to the scale of what we have seen here with this disruption. I mean, even somebody like Javier Blas, I think he's largely considered in mainstream media like the premier energy sort of commentator, saw a post as recently as today. So if you told me we would be this deep into a total disruption of the Hormuz Strait and Brent would be at sub $100, I would have called you crazy. I'm just paraphrasing him. So, the market is pricing this sort of like a Liberation Day tariff situation, that this normalizes very, very rapidly. It was very lucky that we came into this. Somebody was asking about the oil situation before this. We were coming into with this conflict with very well supplied markets and, a sense that there's almost a glut afoot here. So that was very fortunate. But it really is important that for where the market is right now, that things do progress and that we do get these supply chains running again. Now, there was a question like on specific war scenarios. I don't really want to entertain those. I don't have any geopolitical knowledge better than anybody else out there, especially like if the U.S. wants to pull out and Israel wants to continue. I think that's a really valid question, valid scenario, but I have no idea. It does feel like Trump is hungry for this to end and to end soon because of the market impact. Trump's barometer in terms of his image is very much linked to A, stock market, and B, the price of gas at the pump. Others were saying, he doesn't care about that because he knows he's going to lose anyway. I'm not sure Trump thinks that way, but it's a valid observation to make that if Israel is completely just not satisfied unless there is regime change as well, some of these local other countries that do not appreciate their facilities having been bombed, maybe being sympathetic with that view. Does the U.S.'s position even matter if that is the position of those actors in this? And I'm just asking questions. I have no answers here. So it irks me that we go take a Trump initiative so far when there's just so many other questions complicating this. Sure, obviously the U.S. is a massively important player, but there are other important players here in this conflict. We all want it to end as soon as possible. Of course, I'm thinking as well, just from the humanitarian side, I can't imagine what it's like in Iran now, the disruption of key systems. And that was why Trump absolutely had to back down from that threat on energy infrastructure, because this would have rapidly escalated into a total humanitarian catastrophe in Iran. So
and across the Middle East.
And across the Middle East, of course, if they had started to, Iran had started to look at desalination facilities. Midterms, I think you asked me about, Ola, that was one of the questions as well. I think this is a standard sort of midterm scenario. You've got an unpopular president in a midterm. He's going to pay for it. You've got a little bit of, disruption across the magosphere, if you will. Those that don't like the idea of the U.S. getting aggressive on the international scene. They thought MAGA was about populism and about focusing on the USA and what is he doing in Iran. But I think it's the independent voter that was who gave Trump the victory in the 2024 election that is walking away here. They don't like the tone, the corruption. the enriching of the family at every turn, and I think they're moving away from Trump. So my baseline is that the House goes to the Democrats. That hardly any change needs to happen for that to be accomplished, which basically means Trump's agenda is dead in terms of the fiscal side, not necessarily so of course on the foreign policy side and on the tariff side he can just rebase, which the logic or the foundation of what these tariffs are based on in terms of precedent, etc. So it goes to the Democrats by some reasonable margin, and then the Senate is like tilted, but there are also a handful of senators that are not playing ball with Trump here, and some interesting specific races. So, but then on the other side, you have a Trump that is trying to push this so-called Save America Act, which is about certain standards for voting. I think the midterm elections are going to be very politically controversial and disruptive, with the states fighting with the federal authorities over what the standards should be for being allowed to be able to vote in terms of identification, etc. I mean, this could take on some pretty ugly sort of confrontations and all kinds of the usual conspiracy theories we get from both sides on what has happened and what is unfolding at the voting booth. We're getting on just beyond an hour, but we're happy to entertain another question or two. Are you saying? I think there was one about uranium and the role of nuclear. I just think, isn't it?
Yeah, I did that one. So
yeah.
And there was continued question coming in about the gold story. And I think the best thing is basically just look up on your trader if you're a client, otherwise on home.saxo insights. I posted 2 articles this week, one on Monday, basically, what did I call it? Precious metals hit by liquidity shock as war forces repricing. And yesterday I just highlighted what we could read from the gold crude ratio, which has really been collapsing quite a bit recently, but also how it went in the opposite direction during the pandemic 6 years ago, simply because that back then it was a demand shock. This time it's a supply shock, and how that impacts both oil and crude. So oil and gold. So I think best just to look up those two, and hopefully I'll explain that I've explained why gold suddenly, why it didn't go crazy to the upside when we had this massive geopolitical risk event occurring.
Yeah, there was a fellow on X that as well was outlining some of the ways. While gold is a new asset, potentially it is a new asset in people's portfolios when we have bonds doing what they're doing, which is not for serving as a safe haven in times of trouble, as we've seen in this crisis, concerns about inflation, etc. Gold is that safe haven, but it's also potentially at times sort of a pro-cyclical thing. If you think about, let's take a UAE, a Kuwait, a Saudi Arabia that is unable to get its crude to market. It's not making those oil revenues. If it needs to buy some gold, it doesn't have any revenues to buy gold with to continue to build up its gold reserves. If China is paying suddenly more for energy imports, it has less of a surplus to recycle into gold. There was even a story about Turkey potentially potentially needing to use some of its gold reserves to buy things. So just there are always many angles to any story, and just thought I would mention that one as well. So yes, somebody asking about Germany and gas. Yes, there's a huge reliance on gas in Europe, especially in Germany for industrial uses, and that unplugging of the cheap Russian gas has been devastating to German industry. Basically, whole classes of that industry having to relocate elsewhere or just shut down. So it is an important question for the upcoming heating season. How much can U.S. LNG replace that? How much can Algerian gas replace that? That's a focus for diversifying supply chains, etc. Yeah, I don't know if there are any other ones you want to pick out, Ole, or if we should go ahead and wrap this up.
Yeah, I think we exceeded the 1 hour mark, so I don't think we should take much more time of all the listeners who joined in today.
Okay. I think we'll wrap it there. Apologies to any questions we did not get to. Thank you for your time. We hope you found this session useful. Again, if you didn't get a chance to see that link, there's that link there again for the referral. And it's been great to talk to you today. And yeah, if news develops as it has been lately. I'm sure we might be setting one of these up in a not terribly distant future. So stay tuned for future webinars from Ola and myself and the team. All the best out there. Safe trading,
Thanks very
everybody.
much. Thank you.